On November 15th, 2025, the FDIC published its quarterly banking profile, a 248-page document that most people will never read. Buried in Table Fru A on page 47 is a number that should concern every person with money in a bank account: $620 billion. That's the total unrealized losses sitting on U.S. bank balance sheets right now, not projected losses, not theoretical losses, actual losses that banks are currently carrying. To put that in perspective, that's more than the entire GDP of Sweden. Disclaimer: before we continue, this analysis examines banking sector data and historical patterns. The U.S. banking system faces real challenges from unrealized losses, but outcomes depend on economic conditions, Federal Reserve policy, and regulatory responses that are inherently unpredictable. This is educational content, not financial advice. FDIC-insured deposits have been protected for 90 years, but past performance doesn't guarantee future results. Consult financial professionals for personal decisions. Now, let's understand what this number actually means and whether you should be concerned. The current situation. Here's the reality. The $620 billion figure represents losses that exist on paper but haven't been realized yet. Let me explain with a simple analogy. Imagine you bought a house in 2021 for $400,000 when mortgage rates were at 3%. Banks are in a similar position. Between 2020 and 2021, when interest rates were near zero, banks purchased long-term treasury bonds and mortgage-backed securities yielding 1.5% to 2.5%. These were considered ultra-safe investments. Then, starting in March 2022, the Federal Reserve began the most aggressive rate hiking cycle in 40 years. The Fed raised rates from 0.25% to 5.5% in just 16 months. When interest rates rise, the value of existing bonds falls. It's mathematical. A bond paying 2% becomes less valuable when new bonds are paying 5%. If a bank needs to sell that 2% bond today, they take a loss. That's the $620 billion. It's the difference between what banks paid for these bonds and what they're worth today at current interest rates. Now here's the critical question. Does this mean banks are about to fail? The answer is nuanced. It depends on whether banks are forced to sell these bonds or whether they can hold them until maturity. Understanding unrealized vs. realized losses. This distinction is crucial. Unrealized losses exist only on accounting statements. The bank still owns the bond. The bond still pays interest. If held to maturity, the bank gets its full principal back. The loss is theoretical. Realized losses occur when the bank actually sells the bond at the current market price. That's when the loss becomes real and affects the bank's capital. Most banks, especially large banks like JP Chase, Bank of America, and Wells Fargo, can afford to hold these bonds to maturity. They have diversified deposit bases, strong capital positions, and aren't facing liquidity crises that would force asset sales. The problem arises with smaller regional banks that face two challenges. First, customer withdrawals. If depositors move money to money market funds offering 5% yields, the bank must raise cash. If they've already lent out deposits and their liquid assets are these underwater bonds, they're forced to sell at a loss. Second, concentrated exposure. A regional bank in a single geographic area or serving a specific industry, like tech startups, faces higher risk if that sector experiences stress. This is exactly what happened to Silicon Valley Bank in March 2023. The Silicon Valley Bank case study. Silicon Valley Bank wasn't a small institution. It had $209 billion in assets, making it the 16th largest bank in America. But it had a concentrated customer base: tech startups and venture capital firms. When the Fed raised rates in 2022, tech company valuations collapsed. These companies started burning through cash and withdrawing deposits. SVB had invested heavily in long-term bonds during the low-rate era. When customers started withdrawing deposits, SVB had to sell $21 billion in bonds to raise cash. Those sales triggered $1.8 billion in realized losses. When SVB announced these losses on March 8, 2023, panic spread. Customers, many of whom had deposits far exceeding the $250,000 FDIC insurance limit, feared the bank was failing. On March 9th, customers attempted to withdraw $42 billion in a single day. That's a quarter of the bank's total deposits. No bank can survive that. By March 10th, regulators seized the bank. Here's the critical detail. The FDIC protected all depositors, even those with balances above the $250,000 insurance limit. The total cost to the FDIC's insurance fund was $20 billion. 2 months later, First Republic Bank failed in a similar manner. Cost to FDIC, $13 billion. These two failures alone cost the FDIC $33 billion, more than 25% of the entire deposit insurance fund. How the FDIC actually works. This brings us to a critical misunderstanding about deposit insurance. The FDIC Deposit Insurance Fund currently holds $128.2 billion. Total insured deposits in the U.S. banking system, $10.5 trillion. Do the math. The fund covers 1.22% of insured deposits. Does this mean your deposits aren't safe? No. But it means the FDIC doesn't work the way most people think. And the FDIC is an insurance system, not a vault full of cash. It operates on the same principle as your car insurance. The insurance company doesn't have enough cash to replace every car simultaneously. They rely on the statistical reality that most cars won't crash at the same time. Similarly, the FDIC operates on the assumption that all banks won't fail simultaneously. When a bank does fail, the FDIC has several tools. First, they arrange an acquisition. A healthier bank buys the failed bank's assets and assumes its deposits. This is what happened with First Republic. JP Morgan purchased it. Second, they have a credit line with the U.S. Treasury for up to $100 billion. If the insurance fund is depleted, they can borrow. Third, they can impose special assessments on surviving banks to replenish the fund. Fourth, in extreme circumstances, Congress can authorize additional funding. The system has worked since 1934. No insured depositor has lost money in 90 years. But, and this is important, the system has been tested. Historical precedent. The 2008 financial crisis. Between 2008 and 2012, 465 banks failed. The pace was relentless, sometimes 3 or 4 banks per week. By 2009, the FDIC Deposit Insurance Fund went negative. Not just low, actually negative $20.9 billion. The media asked, is the FDIC broke? Will depositors lose money? The answer was no. The FDIC borrowed from the Treasury, imposed special assessments on surviving banks, and rebuilt the fund. By 2018, the fund was back above the statutory minimum. No insured depositor lost a dollar. Compare this to the 1930s, before the FDIC existed. Between 1930 and 1933, over 9,000 banks failed. Depositors lost an estimated $1.3 billion, equivalent to $25 billion today. Bank runs were common. People literally lined up outside banks trying to withdraw cash before the bank collapsed. The creation of the FDIC in 1934 fundamentally changed banking psychology. Deposit insurance prevents panic. Even if a bank is in trouble, depositors know they're protected up to $250,000. This prevents the self-fulfilling prophecy of bank runs. The savings and loan crisis, another test. The 1980s. Savings and loan crisis provides another historical benchmark. Between 1986 and 1995, 143 savings and loan institutions failed. The FDIC's sister agency, the FSLX, became insolvent. Congress created the Resolution Trust Corporation with $150 billion in funding to manage failed institutions. The government sold off assets, closed insolvent banks, and protected depositors. The total cost to taxpayers was approximately $132 billion in 1990s dollars. It was painful, it was expensive, but the system held. No depositor panic occurred because insurance was credible. What makes today different? The current situation has both similarities and differences to past crises. Similarities. Banks are holding assets worth less than they paid due to interest rate changes. Some regional banks face liquidity stress. Differences. The Fed created the Bank Term Funding Program in March 2023. This allows banks to borrow against their underwater bonds at par value, meaning they can get liquidity without realizing losses. This is a crucial safety valve that didn't exist in previous crises. Additionally, the U.S. economy remains relatively stable. Unemployment is 3.7%, historically low. GDP growth is positive. Corporate default rates are manageable. This matters because bank failures typically cluster during recessions when loan defaults spike. The unrealized losses are concentrated in large banks that can hold bonds to maturity. According to FDIC data, banks with over $250 billion in assets hold 67% of total unrealized losses. These institutions, JP Morgan, Bank of America, Citigroup, are highly unlikely to face the liquidity crises that doom smaller banks. 4 possible scenarios. Let's examine how this could play out. Scenario 1, soft landing. The Federal Reserve begins cutting interest rates in 2026 as inflation normalizes. Bond values recover. Unrealized losses shrink without banks having to sell. Deposits stabilize as rate competition eases. Banks return to profitability. Probability, moderate to high. This is the Fed's stated goal and market expectation. Historical parallel, the 1990s post-savings and loan recovery. Scenario 2, managed stress. 5 to 10. Small regional banks fail over the next 18-24 months due to concentrated exposures or poor management. The FDIC arranges acquisitions by larger banks. Some depletion of the insurance fund occurs, but the Treasury backstop prevents systemic crisis. Probability, moderate. We've already seen this pattern with SVB and First Republic. Historical parallel, the steady drumbeat of bank failures from 2010, 2012, post-financial crisis. Scenario 3, regional banking crisis. A major recession forces multiple banks to sell bonds at significant losses simultaneously. 20 to 30 regional banks fail in a compressed time frame. The FDIC fund is insufficient and requires congressional action for emergency funding. Temporary market panic occurs, but government intervention prevents total collapse. Probability, low to moderate. Requires economic deterioration beyond current baseline expectations. Historical parallel, the 2008-2009 severity level. Scenario 4, systemic collapse. This would require multiple simultaneous failures, a severe recession, Federal Reserve policy errors, and a complete loss of confidence in deposit insurance. The banking system experiences cascading failures similar to the 1930s. Probability, very low. It would require extraordinary government failure and breakdown of modern regulatory infrastructure. Historical parallel, the 1930s, though we now have the FDIC, Federal Reserve emergency lending, and lessons from past crises. What this means for you, if you're an individual depositor with less than $250,000 at an FDIC-insured bank, history suggests your deposits are protected. The FDIC has never failed an insured depositor in 90 years, including through the Great Recession. If you're a business owner or high net worth individual with deposits exceeding $250,000, you have options. Spread deposits across multiple banks to stay under insurance limits per institution. Use CDARS or ICS programs that distribute your funds across multiple banks while giving you a single statement. Maintain relationships with larger, more stable institutions for balances above insurance limits. If you're a bank stock investor, understand that unrealized losses hurt profitability and shareholder value even if they don't threaten depositor safety. Regional bank stocks carry more risk during interest rate volatility. The bottom line. The $620 billion in unrealized losses is a real challenge for the banking system. It's not hidden. It's disclosed in public regulatory filings. It's not negligible. It represents genuine stress on bank balance sheets. But it's not a crisis, yet. The difference between stress and crisis is liquidity. As long as banks can hold these bonds to maturity without being forced to sell, the losses remain unrealized. The Fed's lending facilities provide a safety valve. The FDIC's track record provides credibility. However, this situation requires monitoring. If economic conditions deteriorate, if depositors panic, if multiple banks face simultaneous liquidity crunches, unrealized losses can become realized very quickly. The goal of this analysis isn't to make you panic. It's to make you informed. Understand that your bank holds assets worth less than they paid. Understand that the FDIC operates as an insurance system, not a cash vault. Understand that history shows both successful crisis management and catastrophic failures. The pattern from 2008, from the S&L crisis, from every modern banking stress is this: government intervention protects depositors. It may be expensive, it may be controversial, but it happens. Your deposits at FDIC-insured institutions have 90 years of protection precedent behind them. That doesn't guarantee the future, but it's a stronger foundation than fear-based speculation. If you want to stay informed about banking system stability, economic risks, and financial history, subscribe to this channel. We analyze these issues with data, historical context, and intellectual honesty, not with panic or propaganda. The window isn't closing, the sky isn't falling, but understanding risk is always better than ignoring it. Thanks for watching.